So 2018 will be ending in just a couple of days now, and in this video I wanted to go over my top 3 picks that are on my watch list for January of 2019 and kind of give my overall estimate as to why I think that the company is currently trading at what it's going for, what type of, what type of buying opportunity that I would expect to have reflected in the share price to really make me aggressively either add or start a position in. And I want to kind of just go through, my methodology and a couple of different financial models that I use when looking at companies to really justify, okay, am I going to be buying this company? What's going on right now? Can I justify the, the premium or the discount that I'm paying for, and anticipating of getting the return I want? And so I wanted to just kind of walk through 3 companies that are kind of, on my watch list, and I really am, eager to buy, say on the dip, over the next couple of months, and I think will be definitely worth, adding to your watch list and may or may not, be a good asset to add to your overall portfolio. If you guys are just tuning in, my name is Dan and this is Millennial Investing, and this channel is pretty much a documentation about, my financial journey. I am recently just turned 22, so I am relatively young, especially in the financial space, but I am trying to put, my finances and everything else, in my financial scope on the right foot at a young age. And so this is me just documenting, my journey and my assessment onto why I think I should be doing something or I shouldn't be doing something. And so if you enjoy any of that, make sure to like and subscribe and stick around for other videos. I am, I try to be as open as possible as to what I'm doing. And I try to talk and, communicate with anybody who talks on my channel as much as possible, because at the end of the day, I just like talking about finances. I am currently a college student getting a finance degree. So if any of that interests you, make sure to stick around. But without further ado, let's jump into the video. So the first company on my list is a company that I have not really mentioned too much about here on this channel so far. Ironically, for being, such a heavy tech type of savvy guy, Apple is a company that I have mentioned here and there, but I've never really given an analysis on it or done any type of breakdown of the company. So over the past couple of months, Apple has definitely been in a, bear market territory. The company is down, north of 20% from its all-time high, and it seems to just be continuing down in this spiral. Now, a lot of this has to do, with iPhone-related things and noise that's going on in the market. The broad market has been tanking. We just hit a bear market. And so I've kind of looked into Apple and seeing, like, okay, is there value here, at least for my, my investment goals? Now, as you guys know, I'm not particularly partial to the Apple brand. I'm a PC guy, tried and true. I like building my own computers. I like being able to take out parts and change them around, from time to time, depending on what I'm doing with with my computer. So as a consumer, I'm not too thrilled to say having Apple as a possible investment. But as for, from buying a really well-run company, I think Apple is one of the best companies in the world, at least for its brand, how it's run, how it returns equity to shareholders and things like that. So I decided to take a look at the company, from a financial standpoint and just kind of, give my overall opinion on what's going on. So running down this list, the PE currently stands at about 12, and when you look at the broad market of about 25, that is a considerable discount. Obviously, depending on what industry you're looking at, you're going to be getting different standard PEs. But across the board, for being one of the largest companies in the world, a 12 PE is relatively surprising for me. A dividend at about, just south of 2% is, relatively in line with the broad market. The S&P is returning about a 2% right now. However, the dividend growth rate for Apple is significantly higher than the majority of dividends out there, north of 15% over the past couple of years. And this is mainly due to, to my reasoning of that. Apple is a cash cow, and they've just decided to return a lot of that equity to shareholders, especially more aggressively. And that's something that if you're a dividend growth investor and, you don't really care about, stock price and things like that, but you want to, say, have a good dividend return over the long term. And if you have, say, a 5-10 year time horizon or even longer, I definitely think that a dividend growth rate of 15 from a company like Apple is a pretty good starting yield, especially for how fast it's growing. So that's something that you definitely would want to consider. And then looking at from a free cash flow stance, it's pretty interesting that Apple is trading at a relative discount. So most companies that I see are trading between a 20 and a 22 price to free cash flow. And Apple, one of the largest companies again in the world, a company that everybody knows about, is trading at a 15 to their cash flow. So that's something that's pretty interesting and something that, kind of piqued my interest to, make me want to dive more and really understand why are people discounting this stock, from a couple of different metrics. So looking at their financials of the past month, their EPS was at about 12.15, and their EPS growth rate from all the analysts over the next 5 years is expected to be in the range of about 13%. And so when you convert that to their PEG or any type of, growth to, fair value type of metric you want to look at, Apple, from a growth perspective, is at a fair value right now. It's at about a 1, which doesn't mean that the company is overvalued or undervalued. It's mean that the majority of what is anticipated is priced in, but it's not too much priced in, so you could still get somewhat of a fair return, but it's definitely not, say, a bargain discount. That's something that would offer you a peg of like a 0.5 would be. Now, on the flip side, if you want to, say, approach this with a discounted cash flow model and say you require a 15% return, which means that you expect to double your money in 5 years, Apple's fair value on that perspective would have to be at about $31.85 for you to assume them as fair value. And you look at the current share price of being 150, right now they're at about a 12% overvalued state from that model. So that's something that's pretty interesting and something I like to, just kind of compare these two models to. Then for me personally, even after that fair value, say, of the discounted cash flow, I want about a 30% margin of safety. Even though it's a company like Apple, larger companies generally, they have to have a very unique buying opportunity for you to really get a large return over the long term with them. That's why the majority of really, successful investors focus on small caps or, mid caps, because they're companies that can, it's easier to take a $1 billion market cap and turn it into a $10 billion market cap than it is to turn something that's about $1 trillion into $5 trillion, over the next, say, 10 years. So if you really want to, say, have a large return on Apple, in my opinion, you don't really need to start a position, or at least not aggressively start a position, until you're in about the $92 range, at least when you're using these two models. Now, the next company I wanted to touch upon is a company that I've reviewed on this channel before, and if you guys are interested in me doing a full stock breakdown analysis on just National Beverage Corp, let me know in the comment section down below. But National Beverage Corp, or Fizz, their ticker symbol, is the company that owns the LaCroix sparkling water brand, and the LaCroix brand has definitely taken off over the past couple of years, and it is definitely a fast-growing segment and a fast-growing product within that segment. So that's something that has piqued my interest as someone that likes buying growth at a fair value as opposed to just bargain value companies that are trading for below what their assets are. I like companies that are pretty fairly valued to undervalued, but are growing and are expected to grow at a much faster rate than the broad market. That's just my cup of tea, and that's what I kind of attempt to invest in. So you look at National Beverage Corp, their PE is at about a 20. They have zero debt on their balance sheet, which something that is, a $5 billion company that is a fast grower that has zero debt is something I like to see, because then even when that growth stops, the company doesn't have to head into bankruptcy. They're able to keep their doors open, no matter what happens in the overall market sense. So that's something I like to see. Insider ownership, their CEO and founder of, their quote-unquote founder of this company is, owns about 3/4 of the company. And so that is kind of an opportunity to me because, one, the majority of the shareholders, being him, Nick, he is able to, kind of be directly compensated with how well the company is doing. And so that means that the company is, should be, assuming he wants to make the most of his money as he can, in a very, cut and dry, I need to make the company be as efficient and as shareholder friendly as possible, because that's directly going to compensate him. And then also, if any other large, either hedge funds, investment companies, or just private equity companies want to, say, buy a large position of this company, they really need to get Nick and the chairman and the rest of the board to really agree on that, and they can buy a substantial amount of the company, generally at a premium. So that's an interesting, kind of play that I see with National Beverage Corp that you don't really see with that many other companies around here, especially in this, in this high growth type of company. And now going back to the sparkling water and LaCroix, the reason why it's so interesting is that the LaCroix brand and then all the other LaCroix type of products that are within it own roughly 16% of the market share of the sparkling water industry. And sparkling water has been growing at about a 12% year-over-year growth rate over the past 5 years. And so that's pretty substantial, because they're competing with companies like Coca-Cola, Nestle, and Pepsi, and all these mega cap companies, and here they are with just a $5 billion or $3 to $5 billion market cap, just kind of twiddling their thumbs, focused on their niche, not really caring about what else is going on in the market. They're cutting off products that aren't as profitable, and they're really focusing on their niche in the sparkling water space. And so this is something that I think is relatively interesting, that they're trading fair-ish value, at least in terms of growth rate, and they're taking a lot of market share away from these mega cap companies, which, could possibly mean that one of these mega cap companies is going to look at the fact that only one owner owns 75% of the company and say, hey, we'll pay you a massive premium to own 25% of the company, or anything like that, and become, stationed to that, so that way they can really start to incorporate the LaCroix brand into their other, portfolio of products. So that's something I find kind of interesting. And now when you look at their financials and then put them in the models that I did with Apple, so their EPS over the past year have been $3.48, and their EPS has been growing at about 25% over the past 5 years and is expected to grow at 25% over the next 5 years. But something that is interesting about the EPS growth is that in recent years, over the past 3 years, it's been closer to 28%. So it means that the growth rate is going faster. This year was a bit of a hiccup because of a lawsuit that I'll get into a little bit later. That was complete BS in my opinion, and it has kind of been shown that it's BS over the past couple of weeks. But that did start to put a lot of pressure onto the company, and I think that was just complete noise. And whether it was a buying opportunity or not, I think that it was just kind of something that was depressing the stock value beyond what was needed for that type of news. So when you look at their PEG, compared to what they're trading at, they're at a 0.8, which is slightly undervalued. It's not a dropping on the floor bargain right now, but it's definitely not overvalued, at least in terms of their growth rate. However, when you look at this from a discounted cash flow model, which is used by the majority of value investors, and say if you want a 15% return compared to the market, say returning 15%, their fair value is sitting at about $57. And so with their current share price of about 71, that is a massive overvalued current stock price. And that's something that I like to see, because even though I do like to invest in growth companies, when you can't just be purely looking at say value investor fundamentals versus growth investor, like the different types of metrics that you're focused on. You can't, in my opinion, it's not smart to just stay with one type of investment philosophy, because you could be drastically overlooking this. So from a growth perspective, this company is relatively undervalued and you could buy it right away and expect a pretty good return. But from a value investor standpoint, you still need a lot more of a cash flow and a lot more return to EPS to even considering buying the stock. So that's something I like to kind of consider. And then if you do the discounted cash flow and you want to say a 30% margin of safety, you won't even touch the stock until it hits about $40 a share. And so that's relatively interesting. However, in say the opportunity of say one of these major companies buying a large portion of Fizz, I do want to say that in compared to its peers, National Beverage Corporation is relatively undervalued. Between like companies like say Monster or SodaStream. SodaStream was just recently bought up by Pepsi, also trading at a higher multiple and had less cash flows than National Beverage Corp currently has, which is just kind of an interesting caveat. Right now across the board, it sits at about a PE of direct competitors, at least in my opinion, of about 30. And so if you use a PE model and you compare that to National Beverage Corp, their fair value from a PE standpoint is at about $104, which means that it's discounted, rather substantially, trading at $71 a share. So these are the models that I like to kind of look at and, just kind of assess, okay, we've got a fast grower right now. How can I really peg what is the actual worth of this company when, my discounted cash flow is saying it's drastically overvalued, and when the peg is saying it's undervalued? What do? I generally look at competitors, especially what they're trading for, and then, in SodaStream's case, what were they bought out for from a larger company, and just kind of see like, okay, ballpark, so I get a range of anywhere between $57 and $104 of what it could be worth, at a fair value perspective. And then, I kind of go, relatively in the middle. So right now I currently think National Beverage Corp is, fairly valued, all else considered. So that's something I wanted to be, bring to your attention, and something that I think that, in the future, especially if it continues this downward spiral, is a company that I think could offer a very attractive, buying opportunity in a relatively short amount of time. And now the last company I wanted to touch upon is British American Tobacco. So this is a company that I talked about, starting investment in possibly in November. And the company has continued to drop off a cliff since then. So if you notice the little stock price, it has lost 20-ish%, in the past month, which is rather substantial. But there are a couple of things that I think are, getting discounted that I do not think should be discounted. So if you're in on the list, the forward PE, and I'm using the forward PE because they just bought Reynolds American, which has made their PE about a 2. So on their forward PE, which is a lot more reasonable, trading at about an 8.3. Their debt to equity is rather high at about a 0.78, but it is not, too overly bearing, especially for a tobacco company, to, me justify like completely wipe them off the board. I don't want to deal with that much debt. And they're currently trading with a dividend yield of 8.5%. So that is a really attractive dividend yield, especially for people that are looking for cash flow. And their price to free cash flow is at about a 15. So it seems like they're undervalued right now. But I want to kind of go into exactly what that means, when you look at their models. So when you look at their models and you say, okay, their EPS from the past 3 months is about 3.82, and their growth rate over the next 5 years is supposed to be a 5.5. And because of the type of company that this is, and because it's focused more so, it's a mature company, it's a stalwart, or it's a a no growth company. I use the Peter Lynch dividend adjusted PEG ratio, which is a ratio that says they take their current dividend yield and they take their EPS growth rate over the next 5 years, and you're going to divide that by what the company is expected to be trading for on their PE. And then in this ratio, you want the higher the number, the better. So 1, you don't even want to look at it. 1.5 is when it's attractive and when you want to buy it, and then anything closer to a 2 and above is like a bargain that you need to buy. And so they're sitting at about a 1.67, which compared to other tobacco companies is relatively undervalued. So that's something that is relatively interesting. And then on a discounted cash flow perspective, again with a 15% rate of return, your fair value is about $31.04. So that means that the current price, about $30.75, is about 2% undervalued, which is relatively interesting. And then if you want a 30% margin of safety on top of that, you're looking to really buy in at about $22 a share. Now, there are a lot of things going on with British American Tobacco and the tobacco space in general that is making their stock price kind of fall off a cliff. The main thing focused on British American Tobacco is the FDA ruling, and I kind of talked about it when I talked about my Marlboro video, and I'll put a link to it here, is that they are thinking about, banning or limiting the sales of, mint and menthol-based tobacco products. A lot of this has to do with Juul and a lot of vaping companies. However, when you look at what the actual proposition was and not just the headlines of what the FDA was talking about, it doesn't mean that they're not going to be able to sell, say, Newports, which is, the British American flagship brand here in America. You simply just won't be able to, if this passes, however long that takes, it won't be able to be bought, say, at a gas station. That doesn't mean you can't buy and sell Newports. So, in my opinion, a lot of that is kind of, overreaction, because I've never met a smoker in my life that just because their brand of cigarettes, is no longer sold, that they quit smoking. Or, if they have a brand of cigarettes and now instead of going to the Cumberland Farms, when they get their gas and get their cigarettes, that they won't drive an extra 2 minutes to go to a smoke shop or a liquor store and then just buy their pack of cigarettes there. I've never met a smoker that, would just immediately stop smoking accordingly. So the really only threat that comes to British American Tobacco because of this FDA ruling would be if they say don't want to make that extra trip, or they don't have the ability to say make that extra trip, say if there's not a smoke shop near them, that they're going to switch to say Marlboros or any other non-Camel or any other product that is under the British American umbrella, or they switch to vaping. They're going to just switch to a product, and then that revenue is going to leave British American Tobacco. I personally do not really think that that would happen. However much speculation you want to assess that kind of a thesis, I personally don't think that that's going to happen, and so that's why I think that they are still a relatively attractive play, and now supporting an 8.5% dividend yield is something that I might start to aggressively buy over the next couple of months. So wrapping up, just a quick rundown of my final thoughts and what my theses are for each of these companies. Apple is a company that I like if the overall market is doing reasonably well. This will benefit from people that are just buying, standard ETFs, because every ETF roughly has Apple, whether it's consumer discretionary, whether it's, the S&P as a whole, the S&P growth, any major indexy, or, just the S&P or the Dow in general, anybody that's dumping money into, say, an index fund is dumping money into Apple inherently. And also, I think that, the overall iPhone scandals that are going on right now have, assuming that, the overall economic, type of scope that is going on right now doesn't fall off a cliff, I think it's a relatively over-pessimistic approach that people are having to Apple, which is something that we've seen time and time again, especially when any smartphone doesn't sell that well. Obviously, the last iPhone didn't sell as well as people anticipated, but when you look at it, neither did Samsung's and neither did other flagship companies. Obviously, you have Huawei, which was, kind of gaining market share here, but they still weren't selling, at a groundbreaking rate. So I definitely think that this is just kind of the TikTok cycle of tech, and I don't think people needed to upgrade their phones. And at the end of the day, if they didn't need to upgrade their phones, Apple's not going to sell as many iPhones. They still grew, mind you, but it's just not as much as people thought. National Beverage Corp, I think, is a relatively interesting company, at least over the long term, assuming millennials still enjoy sparkling water as a healthier alternative to soda, and that any type of mega beverage corporation is going to be looking into buying stake or large portion of the company in order to add their premium sparkling water brand to their own portfolio of brands. And I think that is relatively likely to happen, assuming that the majority shareholder of the company, Nick, is going to actually offer up some of his holdings in the company. And British American Tobacco, I think is a, pretty interesting play, especially if you're looking for a dividend cash, type of cow to your portfolio. You want that cash flow, you want that really high yield on cost, and you are relatively skeptical like me of the whole FDA ruling, and you assume that the FDA ruling is not going to happen, the next couple of years, or you don't think it's going to be as catastrophic as people are anticipating. Because right now, the way I see it is that people are pretty much looking at the fact that BTI gets 55% of its American revenue from menthol-based cigarettes because it owns Newport, and they're assuming that that is just going to disappear, or the majority of that is going to disappear. I am relatively conservative in how much is going to go away, whether that be intelligent or not on my half, you be the judge of that. I only see, probably about a 20%, at max revenue loss from that, but that's just my opinion. So thank you guys for watching. Hope you guys got some use out of this. Let me know if you guys are interested in any of these picks, or, if you have any other picks for the month of January that you were really keeping an eye open for. Thank you guys for watching to the end of the video. And again, if you stuck around to the end of the video, please, I urge you to either like this video or subscribe if you haven't already. It really helps out the channel. And thank you guys, and I hope you guys have a great new year, and I'll catch you guys in the next video. Peace.